The silver market just flashed a signal that should terrify anyone holding a short position right now. And I'm not talking about some minor technical indicator or a temporary supply hiccup. What's unfolding in the silver market represents a structural shift that's been building for years, and we're now at the breaking point where the entire paper silver system could unravel in spectacular fashion. Let me show you exactly what's happening, because the data tells a story that most mainstream analysts are either missing or deliberately ignoring. We're looking at the 8th consecutive year of physical silver deficits. Think about that for a moment. 8 years where global demand has exceeded mine supply. 8 years where above-ground inventories have been steadily drained. And now we're sitting at inventory levels that are at historic lows, while futures positioning shows only a fraction of contracts are actually backed by deliverable metal. The mechanics of what's happening are actually quite simple, but the implications are profound. The silver market operates on two levels. There's the physical market where actual metal changes hands, bars get delivered, coins get minted, industrial users take delivery from manufacturing. Then there's the paper market, the futures exchanges where contracts get traded back and forth, where price discovery theoretically happens, where massive leverage allows traders to control huge positions with relatively small capital. For decades, these two markets existed in a kind of uneasy equilibrium. The paper market would set the price, and the physical market would mostly follow along. Sure, you'd see premiums spike here and there when physical demand got hot, but generally the system worked. Shorts could suppress rallies by dumping paper contracts. Longs would get squeezed out when they couldn't take delivery. The game had rules, and the big players knew how to play it. But something fundamental has changed. The physical market is no longer willing to accept the price signals from the paper market. And when you dig into why, you start to understand just how precarious this entire structure has become. Start with the supply side. Global mine production has essentially plateaued. We're not finding major new silver deposits. The easy ore has been mined. What's left requires more energy, more processing, higher costs. Meanwhile, existing mines are aging. Grade decline is a real issue. You're processing more rock to get the same amount of silver. And here's the kicker. Most silver comes as a byproduct of other mining operations. Copper mines, lead-zinc operations, gold projects. So silver supply is actually constrained by the economics of these other metals. You can't just ramp up silver production because the price is rising. It doesn't work that way. On the demand side, you've got this perfect storm of forces all converging at once. Industrial demand keeps climbing because silver is irreplaceable in so many applications. Solar panels, electronics, medical devices, water purification, batteries for electric vehicles. These aren't discretionary uses. These are mission-critical applications where silver's unique properties, its conductivity, its antimicrobial characteristics, its reflectivity make it absolutely essential. And as the world electrifies, as the green energy transition accelerates, industrial silver demand isn't just growing, it's accelerating. Then you layer on investment demand. And this is where things get really interesting. Because investment demand for silver isn't just about speculation or trading. It's about wealth preservation in an era where trust in fiat currencies is eroding. It's about portfolio insurance when traditional assets are overvalued. It's about having something tangible when everything else is just digits on a screen. Before we go further, I want to mention something quickly. If you're watching this and you're thinking about how to protect your wealth in this environment, I put together a free guide that shows the savings secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, just practical information you can use. Now, back to what's happening in the silver market. Because the real story isn't just about supply and demand fundamentals. It's about market structure and what happens when that structure gets stressed to the breaking point. The COMEX, the primary futures exchange for silver trading, operates on a fractional reserve system. Not every futures contract is backed by physical metal sitting in a vault. In fact, most aren't. The system works on the assumption that most contracts will be cash settled, that traders will close positions before delivery, that physical demand will remain manageable. But what happens when that assumption breaks down? Recent data shows that registered silver inventories, the metal actually available for delivery against futures contracts, have been declining steadily. We're talking about inventory levels that represent just a tiny fraction of open interest. Some analysts calculate the coverage ratio, how many ounces of registered inventory exist per ounce of open interest, and the numbers are shocking. We're looking at coverage levels that would have been unthinkable just a few years ago. This creates a fascinating dynamic. Short sellers, the traders betting that silver prices will fall, are essentially writing checks against an account that's running low on funds. They're promising to deliver metal that may not actually be available when the time comes. And the longs, the buyers, are starting to figure this out. They're starting to stand for delivery. They're demanding physical metal instead of accepting cash settlement. What happens when an unstoppable force meets an immovable object? What happens when delivery demands exceed available supply? You get a short squeeze. But not just any squeeze. A squeeze that could fundamentally reset the price of silver because it would expose the true scarcity of physical metal. Let me paint you a picture of how this could unfold. Imagine you're a large institutional player, maybe a hedge fund, maybe a sovereign wealth fund, maybe a family office managing serious money. You've been watching the silver market. You've done your homework. You understand the supply deficit. You see the inventory drawdown. You recognize that the paper price doesn't reflect physical reality. So you start accumulating futures contracts, not to trade them, not to flip them for a quick profit, but to take delivery, to convert paper claims into physical metal. At first, the market barely notices. A few contracts stand for delivery. The exchange finds the metal. Transfers get made. Business as usual. But then more players catch on. More contracts stand for delivery. The registered inventory starts dropping faster. The shorts start getting nervous because they're on the hook to deliver metal they don't have. They try to buy it in the physical market, but there's not enough available at current prices. So they have to bid higher, much higher. This is where the squeeze mechanics really kick in. As prices rise, more shorts get margin calls. They have to either post more collateral or close their positions. Closing means buying back contracts, which pushes prices even higher. This triggers more margin calls, more forced buying, a feedback loop that feeds on itself. And all the while, physical metal keeps flowing out of the exchange warehouses because the longs keep taking delivery. The shorts have three options, none of them good. They can try to buy physical metal to make delivery, but that means paying up in a market that's already tight. They can try to buy back their futures contracts, but that means taking losses and pushing prices higher. Or they can default, which would be catastrophic for market confidence and could trigger a complete breakdown of the paper-silver system. Now, you might be thinking, this sounds theoretical, like something that could happen but probably won't. Except we've seen this movie before. Not in silver specifically, but in other commodity markets where paper claims exceeded physical availability. Nickel on the London Metal Exchange. That was a preview of what can happen when shorts get caught in a genuine squeeze. Trading halted, contracts canceled, billions in losses, market credibility destroyed. The difference with silver is the scale and the implications. Silver isn't just another industrial metal. It's a monetary metal with thousands of years of history as money. It's the poor man's gold, accessible to regular investors in a way that gold isn't. It's held by millions of people around the world as insurance against currency debasement and financial system instability. A short squeeze in silver wouldn't just be a trading event. It would be a monetary event with ripples across the entire financial system. Think about the institutions that are short silver. Commercial banks, bullion banks. These aren't small players. These are systemically important financial institutions with exposure across multiple markets. If they take massive losses on silver shorts, what does that do to their balance sheets? What does it do to their ability to make markets in other assets? What does it do to confidence in the broader financial system? And here's where it gets even more interesting. Central banks have been accumulating gold at record pace. Everyone knows this. It's been headline news. But silver? Silver has been largely ignored by official sector buyers, which means the entire above-ground supply of investment-grade silver is in private hands. There's no central bank that can dump silver to suppress a rally. There's no government stockpile that can be mobilized to ease a shortage. The market is on its own. This creates an asymmetric opportunity for anyone paying attention. The downside is limited. Silver has industrial value. It has monetary value. It's not going to zero. But the upside? The upside is potentially enormous if we get a genuine short squeeze that forces a repricing of physical metal relative to paper claims. Look at what happened during previous silver squeezes. The Hunt brothers in the late 70s pushed silver from single digits to $50 an ounce. That was with a completely different market structure, different supply-demand dynamics, different monetary environment, but it showed what's possible when concentrated buying meets limited supply. More recently, the retail-driven squeeze saw silver spike from the mid-20s to nearly $30 in a matter of days. That was just retail buyers coordinating on social media. Imagine what happens when institutional money decides to make a serious move. The technical setup right now is fascinating. Silver has been consolidating in a range, building energy like a coiled spring. The longer this consolidation continues, the more explosive the eventual breakout will be, and the fundamentals keep getting tighter. Every month that passes with a supply deficit is another month of inventory drawdown. Every ounce that flows into industrial use is an ounce that's not available for investment. Every coin that gets purchased and put in a safe deposit box is an ounce removed from the tradable supply. The shorts are betting that this time will be different, that somehow the market will find equilibrium, that new supply will emerge, that demand will moderate, that the paper market will maintain control over price discovery. But what if they're wrong? What if we've reached the point where the physical market simply refuses to accept paper market pricing anymore? This is where understanding market history becomes crucial. Every major commodity bull market has been driven by the same basic dynamic. Supply can't keep up with demand, inventories get drawn down, and eventually price has to rise to ration scarce supply and incentivize new production. We saw it in oil. We saw it in copper. We saw it in lithium. And we're seeing the setup in silver right now. The difference is that silver has this dual nature. It's an industrial commodity, yes. But it's also money. It's also a store of value. It's also a hedge against monetary instability. So when silver starts moving, it doesn't just move on industrial fundamentals. It moves on monetary fundamentals too. And in an environment where governments are running massive deficits, where central banks are trapped between inflation and recession, where currency debasement is the path of least resistance, the monetary demand for silver could dwarf the industrial demand. Let me give you a concrete example of how this plays out. Say you're a retiree with $1 million in savings. You've got it in a mix of stocks and bonds, maybe some cash. You're watching inflation erode your purchasing power. You're watching your bond portfolio lose value as interest rates fluctuate. You're watching stock market volatility make you nervous. Someone tells you about silver, about how it's been money for thousands of years, about how it's in a structural supply deficit, about how it's dramatically undervalued relative to gold, relative to stocks, relative to real estate. You decide to put 5% of your portfolio into physical silver. That's $50,000. At current prices, that's a meaningful amount of metal. Now multiply that by millions of retirees making similar decisions. Where does that metal come from? Who's the seller? At what price does supply meet demand? This is the question that keeps the shorts up at night. Because they know the math doesn't work. They know that if even a small percentage of investment capital decides to allocate to physical silver, there simply isn't enough metal available at anywhere near current prices. The market would have to reprice dramatically higher to ration supply and discourage demand. And here's the thing about short squeezes. They don't happen gradually. They don't give you time to adjust your position. They happen fast, violently. One day, everything seems fine, and the next day the market is gapping higher. Shorts are scrambling to cover, and prices are moving in ways that seem impossible until they're happening right in front of you. The warning signs are all there if you know where to look. Backwardation in the futures curve, where near-term contracts trade at a premium to deferred contracts, indicating tightness in the physical market. Rising premiums on physical products, coins and bars trading well above spot price because dealers can't source metal. Lengthening delivery times, where orders that used to be filled in days now take weeks. These are all symptoms of a market under stress, a market where physical demand is overwhelming available supply. Now, if you're sitting on retirement savings and you're thinking about how to position for what's coming, this is something you need to understand. The traditional 60-40 portfolio, stocks and bonds, was built for a different era, an era of stable currencies, moderate inflation, predictable central bank policy. That era is over. We're in a new paradigm where the old rules don't apply, where the old strategies don't work, where you need different tools to preserve and grow wealth. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, how to diversify beyond traditional assets, how to hedge against the kind of market instability we're seeing. Worth checking out if that's relevant to your situation. No obligation, just information. Anyway, back to the silver squeeze and what it means for the broader market. Because this isn't happening in isolation, silver is part of a larger story about real assets versus financial assets, about tangible wealth versus paper claims, about what has value when trust in institutions and currencies erodes. Look at what's happening in the gold market. Central banks buying at record pace, premiums in Asia, tightness in London. These are all signs that the physical precious metals markets are repricing relative to paper markets. Silver is just further behind in this process because it's a smaller market, more volatile, less institutional participation. But the same forces are at work. And when silver catches up, when it starts moving the way gold has been moving, the percentage gains could be dramatic because silver tends to be more explosive than gold on both the upside and downside. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been historically elevated. We've seen ratios above 80, even above 90 at times. Historical averages are much lower. During precious metals bull markets, this ratio tends to compress as silver outperforms gold. If we see that compression happen again, if silver starts catching up to gold's gains, we're talking about potential moves that would be life-changing for anyone positioned correctly. But here's what most people miss. The squeeze isn't just about price going up. It's about the revelation of true scarcity. It's about the market discovering that physical silver is far more rare and valuable than the paper price suggests. It's about a reset in how we value real assets versus financial assets. And once that reset happens, once the market reprices silver to reflect physical reality, there's no going back. The genie doesn't go back in the bottle. Think about the implications for industrial users. Companies that depend on silver for manufacturing. If they've been relying on just-in-time delivery, if they haven't secured long-term supply contracts, if they've been treating silver as just another commodity input, they're going to face a rude awakening. They'll have to pay up. They'll have to lock in supply at much higher prices. They'll have to pass those costs on to consumers or absorb them in margins. Either way, it's inflationary. Either way, it reinforces the case for holding real assets. The geopolitical dimension adds another layer to this story. We're seeing a multipolar world emerge. We're seeing countries diversify away from dollar dependence. We're seeing trade settled in alternative currencies. We're seeing central banks accumulate gold as a neutral reserve asset. Silver fits into this narrative as a monetary metal that's accessible, portable, divisible. It's the people's money in a way that gold isn't. And in a world where trust in fiat currencies is declining, where people are looking for alternatives, silver's monetary role could reassert itself in powerful ways. There's also the technological angle. The green energy transition requires massive amounts of silver. Solar panels are the obvious example, but it goes beyond that. Electric vehicles, 5G infrastructure, advanced electronics, all of these technologies are silver-intensive, and these aren't optional technologies. These are the foundation of the modern economy, which means silver demand from these sectors is structural, not cyclical. It's going to keep growing regardless of economic conditions because the technological shift is happening, regardless of economic conditions. Now layer on the investment demand that comes when people realize what's happening, when they understand the supply deficit, when they see the inventory drawdown, when they recognize the squeeze potential. That's when you get the momentum, the FOMO, the rush into physical metal that overwhelms available supply and forces the dramatic repricing. The shorts are trapped. They can't cover without pushing prices higher. They can't deliver without buying metal they don't have. They can't default without destroying market credibility. They're hoping for a miracle. They're hoping demand moderates. They're hoping new supply emerges. They're hoping the longs lose patience and sell. But hope isn't a strategy, and the fundamentals keep getting tighter. Every day that passes is another day of deficit, another day of inventory drawdown, another day closer to the breaking point where the paper market loses control and the physical market takes over. And when that happens, when we get the squeeze that's been building for years, it's going to be spectacular. Not just in terms of price movement, but in terms of what it reveals about the fragility of our financial system, about the difference between real assets and paper claims, about what actually has value when the chips are down. This is why paying attention to silver right now is so important. Not just as a trading opportunity, though it certainly is that, but as a window into larger forces reshaping the financial landscape. The silver squeeze is a symptom of a broader crisis of confidence in paper assets, in fiat currencies, in the institutions that manage our monetary system. It's a signal that people are waking up to the difference between what's real and what's just a claim on something real. The question isn't whether silver will squeeze. The question is when and how violent the move will be when it happens. Because the setup is there. The fundamentals are there. The technical pattern is there. The market structure is there. All the ingredients are in place. It's just a matter of the catalyst, the spark that ignites the powder keg. And here's the thing about catalysts. You never know what they'll be until after the fact. It could be a major industrial user trying to secure supply and discovering there isn't enough available. It could be a large institutional buyer deciding to take delivery on futures contracts. It could be a geopolitical event that drives safe haven demand. It could be a currency crisis that makes people rush into tangible assets. It could be something completely unexpected that nobody saw coming. But whatever the catalyst, when it happens, the move will be fast. There won't be time to position after the fact. There won't be time to do your research and make a careful decision. The opportunity will be for those who understood what was coming and positioned ahead of time. For those who recognized the warning signs and acted while everyone else was still skeptical. The shorts have been warned. The data is clear. The inventory levels are clear. The supply deficit is clear. The market structure is clear. They're betting that somehow this time will be different, that somehow they'll escape the consequences of their positioning. But markets have a way of teaching expensive lessons to those who ignore fundamentals, and the silver market is about to teach a lesson that will be remembered for decades. For anyone watching this who's been on the fence about precious metals, who's been wondering if now is the time to act, let me be clear. The risk-reward here is asymmetric. The downside is limited by industrial value and monetary history. The upside is potentially enormous if we get the squeeze that the fundamentals suggest is coming, and the time to position is before the move, not after. This isn't about speculation. This isn't about trying to time the market perfectly. This is about understanding structural forces and positioning accordingly. It's about recognizing when a market is mispriced and taking advantage of that mispricing before it corrects. It's about having the courage to act on your convictions when the crowd is still skeptical. The silver market just sent a final warning to shorts. The inventory levels are flashing red. The supply deficit continues. The physical market is tightening. The squeeze mechanics are in place. What happens next will depend on how quickly the shorts recognize their predicament and how violently they try to escape it. But one thing is certain. The current price doesn't reflect the physical reality of the silver market. And when markets diverge from reality, reality always wins in the end. For those of you who've watched this far, I want to mention one more thing. That free guide I mentioned earlier, the one in the description about protecting your wealth, if you're an American retiree with at least $100,000 in any retirement account, and you mention you watched this video, you'll get access to an exclusive one-on-one educational web conference. No obligation, no pressure, just a chance to learn from experts about strategies thousands of retirees are using to protect their hard-earned wealth in these uncertain times. It's only available to those who qualify and mention this video, so if that's you, definitely check it out. The silver squeeze is coming. The only question is whether you'll be positioned for it when it arrives. The shorts have been warned. Now it's up to you to decide what you do with that information.